Welcome to Manifested e-learning platform. Today we are going to tackle taxation of air and sea transport undertakers. Number one, we need to understand that this is basically taxation. Refers to taxation of owners of ships. Taxation refers to the taxation of what we call owners of ships, taxation of owners of ships, and what we call aircrafts, owners of ships and aircrafts, taxation of owners of ships and aircrafts operating in Kenya. Operating in Kenya. And when you talk about this, when you talk about ships and aircrafts, basically it involves passengers. One of it is passengers. We have cargo handling, but we also have handling of mail as some of the activities that they basically carry. So we need to understand that they are taxed. They are taxed. They are taxed at a corporate rate of 30% for what you call for resident companies, and we say, and 37.5% we say for the non-resident. We say for the non-resident company. The tax at a corporate rate of 30%, that is for the resident company, and 37.5%, that is for the non-resident company. So we need to understand that the taxable income, income is basically determined, we say it using what we call the following methods, using the following method. So we say that when you talk about taxation of air and sea transport undertaking, taxation of owners of ships and aircrafts operating in Kenya. And we know that for the ships, they are basically engaged in passengers, cargo handling, and also the mail, the aspects of the mail. I have said that we tax them at a corporate rate of 30%, that is for the resident company, and 37.5% for the non-resident company. And you say that in determining the taxable income, we basically use two methods. And that is, number one, we call it the net profit method. And then we have two, what we call the gross profit method. So for the net profit method, we apply it when we've been given the accounting profit. And so basically we adjust the accounting profit in order to get the taxable profit. And we understand areas in where we have a difference in taxation of accounting profit and taxable profit. One of the areas that we know that an expense called depreciation is allowable in accounting, but in taxation we do not allow depreciation, but instead of depreciation, basically in taxation we grant what we call investment allowance. For the gross profit method, we are not provided with accounting profit. So we get the taxable operating incomes and then we less the allowable expense. Allowable expense, taxable income, those are the basics that have been discussed. When you talk about taxable income, example are the gross profit is an example of a taxable income. Bad debts recovered that were previously written off, that should be taxable income. Decrease in specific provision for bad debt, that's also an example of taxable income. Examples allowable expenses, revenue and commercial expenses. We also know that there are also other allowable expenses, for example, investment allowance. There are also legal fees that are allowable, that we say preparing and renewal of a lease that is less than 99 years, that should also be allowable expense. But particularly for specialized, there are very key things that needs to, the following specifically, we say the following, we said that the following specifically apply. The following specifically apply, very key under those specialized, apply to taxation, of ships and what they call aircrafts. And these are very key. Now, in addition to understanding allowable expense, non-allowable expense, taxable income, and non-taxable income, the following items are very important. One, we say that non-resident, we say non-resident, we say that the non-resident income, very important, income generated, and we say that when we talked about ships, I talked about passengers, I talked about cargoes, and I talked about mail as sources of their income. The non-resident income generated en route from other countries, to Kenya. Very important, to Kenya, because this is one of the areas that you'll be tested in terms of those income. So we say that non-resident income generated en route from other countries to Kenya is exempted from tax, meaning it is not charged. It's usually into Kenya, en route into, we just say into Kenya is exempted from tax, is basically exempted from tax. So such an income is not subjected to tax. That is under shipping and aircrafts. Non-resident income generated en route from other countries into Kenya is exempted from tax. Very important in relation to getting the incomes for the shipping company. And number two, very important, we know that investment allowance. And when you look at this particular question, we look at the present rate. Even when you particularly handle questions that are not present, we need to fix them to the present rate and talk about investment allowance that relates to ships and aircraft. So investment allowance that particularly relates to the ships and aircraft, if you look at the tax table, you'll see that wear and tear is basically granted at 50% in the first year and 25% per annum on a straight line from the second year on the remaining balance. So say ships and aircrafts qualify for wear and tear, qualify for wear and tear allowances at the rate of 50%, in the first year of use. In the first year of use, and 25% per annum on a straight line, from the second year, from the second year on the remaining balance. Very important, because we understand allowable expenses, we understand the taxable income, but now for the taxable income, as I stress, for the non-resident income generated en route from other countries into Kenya, that is basically exempted from tax. And then we say that ships and aircraft qualify for wear and tear allowance at the rate of 50% in the first year of use and 25% per annum on a straight line on on a straight line from the second year on the remaining balance.